Beef prices have risen at an annual average of 3.75% over the last century, and since 2019, that's jumped to 5.72%. And that sounds bad, but it's been worse for Tyson Foods, a stock that we rate at 10 out of 10. After a banner year in 2021, the company got smoked by higher cattle costs, and its chicken and pork profits also fell sharply. Now, we scour Trackstar, our proprietary sentiment indicator, for notable jumps in search interest. However, declines in search volume also catch our attention, and financial pros have stopped looking at Tyson Foods. Forecasters expect cattle, chicken and pork prices to fall over the coming months, and that's put Tyson at an incredibly cheap valuation, one that's too good to ignore. Now, founded in 1935, Tyson Foods is one of the world's largest food companies and top protein producers. Its brands include Jimmy Dean and Hillshire Farm. It's one of the big four companies that produce up to 85% of the beef, pork and chicken in the US, along with JBS, National Beef and Cargill. Tyson's done well at improving the top-line results above those of typical packaged food companies. 2021 was incredible for Tyson. The company improved operating margins by 2.4% and profit margins by 1.7%. That might not sound like much, but it's very meaningful for a food processor. Tyson trades at just 9.1 times trailing 12-month earnings and 14.3 times forward earnings, and that's better than most peers. Additionally, Tyson's price to sales, price to cash flow, and price to forward cash flow ratios are all pretty compelling. Tyson has respectable gross margins given the size and scope of its business too. The net income margins suffered due to inflation, but we expect those to improve as cattle costs fall. We love the risk reward on Tyson. First, you get a 3% dividend while you wait, and second, the company plans to save hundreds of millions of dollars through the use of automation. Lastly, and most importantly, should input costs drop, then current profit forecasts are far too low.